So lecture 4, receivables, inventory, and non-current assets. Where we have been to up to now is basically been going through, here is an economic event which takes place. We buy something, we sell something, we incur an expense, we earn revenue, whatever it happens to be. Stuff happens, and then we get it from the event happening into the journal entries, into the T accounts, into the trial balance, into the financial statements. What we're doing with these couple of pieces is looking at specific areas. So with accounts receivable, an account receivable is when you sell something to someone, I've sold something to you, and you haven't paid me cash up front. So you owe me some money. That's an account receivable, or generates an account receivable. Now, what's a potential issue about accounts receivable? So say I've sold $1,000 worth of things. What's a potential just business concern about that? So I have $1,000 owed to me. Forgetting about the accounting for it, what's just a general business concern about that? Yeah. The concern is we may not get all that money back. That's, when we're talking about receivables today, that's what we're trying to deal with. Now, there's different mechanical ways, and we work out some numbers and we do some entries, but at the heart of it is when we record an account receivable up front when we make the sale, we're not sure that everyone's going to pay us back. And what we're going to be doing for the first little bit is looking at how we deal with that from an accounting point of view. That's the first bit. With inventory, what we're worried about is how we cost inventory when we buy it, because there's lots of different things included in the cost of inventory, and we just need to get a sense of what gets included and what doesn't. So we're going to look at that. And then we're going to look at how inventory becomes an expense. Now, the reason why that is an issue is because when companies buy inventory, so whether it be retailers or whether it be manufacturers that buy the raw materials to make the inventory, the prices of which they buy that stuff at change. So things aren't always, they're not going to buy the same item. It might be the same thing, but it's going to be at different prices. We know petrol changes price. We know commodities change price. We know fruit and veg change price. I mean, I'm sure even pretty much everything in the supermarket, the supermarket won't buy it at the same price for the same thing over the course of the year. So we need to come up and figure out how that plays out with knowing what we actually sold and what cost to put against what we sold. So we'll explore how that happens. And with non-current assets, when you buy a non-current asset, like property, plant, and equipment, so this building was about $180 million. Debit, property, plant, and equipment, credit, cash. That's an asset, that's an asset. Asset going up, asset going down. What you'll see is there is no profit and loss effect in that entry. The whole point of the property, plant, and equipment section, which we're going to go through, I mean, there's lots of different things as you go into more technical areas about property, plant, and equipment, but what we're going to look at is two parts. One, how we get that number, and that's pretty straightforward for what we're doing in this subject. The second bit is how we get that number into profit and loss. Because it's going to be, we spent $180 million. We're using this building and we're going to use it for a number of years. We need to reflect that that's a cost to us doing the things which earn revenue for this organization. So we need to get that matching going properly. So that's dealing with depreciation. That's where we're going. So describe the recording and reporting of receivables. Understand the methods used to account for uncollectible receivables. Understand the methods for estimating bad debts expense. Describe inventory and how it's recorded, expense reported. Calculate the cost of goods sold. Describe property, plant, and equipment. Calculate depreciation methods and how we get rid of it. So it's kind of like bringing inventory in, selling it, bringing property, plant, and equipment in, using it, selling it. It's almost like a life cycle aspect to these different things. So a receivable represents a business's claim on the assets of another entity. So I've sold things, people owe me money. Most common type of receivable is an account receivable, which is typically a current asset, and that's owed by a customer who purchases the company's product or service. Sometimes called trade receivables. So we have a $1,000 sale. This entry we're familiar with. We've looked at this, we've seen this. There's nothing really all that interesting about it. We have an asset, and we have sales revenue. But as Louise has pointed out, and others have mentioned, we can't guarantee that we're going to receive all that money. And the issue is, because there are different ways to account for it, but the way that's required from an accounting point of view, so if we make the revenue in this period, that sale, whatever period, we don't know what it is, but we make it in this period of time. If we were to wait until we know with absolute certainty that that person isn't going to pay us back, or certain people aren't going to pay us back, and then record the expense, that's a problem. Because the expense for this revenue happens in a different period. This will be off against the revenue from this period, which won't, conceptually that's a problem. So the point of the allowance method, which we'll just see, brings that expense. So that expense doesn't happen out here. It makes sure that the revenue that we get from making the sale happens in the same period as the expense for that sale. So whether it be cost of goods sold expense, which happens in that period, but also any bad debts expense happens in that same period. So under the allowance method, firms prepare an adjusting entry. So it's an adjusting entry, this happens at the end, but it's in that period still, to record an estimate of uncollectible accounts. We'll come back to this point later. This is really important, but we'll come back to it. The entry, so if we think about what the sale entry is, it's debit account receivable, credit, sales revenue. I'm jumping the gun a little bit, but the entry that we're going to have is debit bad debts expense and credit an allowance for bad debts. So what we have here from an account type is we've got an asset, we've got a revenue, we've got an expense, and this is a contra asset. It will net off against this one. It's not a liability even though it's got a credit balance. It's an allowance for bad debt. So these two are balance sheet amounts and these two are profit and loss amounts. So you'll see that we're matching up the revenue with the expense in the period in which that sale happens. Gives us a matching of bad debts expense with revenues. And what it also does is it gets the account receivable reported at the amount that you think you're going to get. So imagine we made 1,000 in sales and we think maybe we're not going to collect 20. It would be 1,000 less 20 gives us 980. So when we look at the balance sheet, we see that we only expect to get in 980, which means we're only really showing the accounts receivable at their fair value or their net realizable value. And when we talk about net realizable value, it's just the amount that we think we're going to get, the actual what we're going to realize from collecting, because not everyone is going to pay us. So the allowance for bad debts, already talked about, it's a contra asset, and it's set up as accounts receivable less allowance for bad debts. It gives us your net realizable value. So if it was 1,000 less 20 gives you 980. Now the thing with it is, This entry will always happen at the end of each year. If you've got credit sales, you will have an allowance for bad debts. So you always have this debit bad debts expense credit allowance. That's not the controversial bit. You just need to remember that happens. The issue which is problematic, firstly, from a mechanical point of view, we've got to work out how to come up with the number. But secondly, what this then represents, the issue is that number. Firstly, just how we get it. And then secondly, what are some problems with how we get it? So we're going to do the mechanics of it first, and then we'll talk about it. So percentages, there are two ways. There's actually probably more than two ways, but there's two main ways that we look at it. So percentage of sales or percentage of accounts receivable, this is probably the better way to do it, accounts receivable. They're both fairly easy to do, but this probably makes the most sense. If you've got the slides written, or sorry, printed out, highlight this. The percentage, whatever percentage, whichever approach we use, is based on prior experience. Now, what you should also maybe add in somewhere is this is based on management's assumptions. Company management are the ones who come up with these numbers. And that's actually, if you look at the technical requirements and the standards about this stuff, it actually puts it in black and white saying this is based on what management thinks is going to happen. So this is, and we'll talk about why that's important once we've done the mechanics. So management come up with these numbers. So suppose a company with $250,000 in sales estimates that it will not collect 4%. So these are $250,000 of credit sales, not collect 4%. The estimate for bad debt expense at the end of the year is $10,000. 4% times 250, that makes sense. The entry still looks like this. Debit bad debts expense, credit allowance for bad debts. So there's nothing different to what I've done here. We've just come up with a number. That's all that we've done. It's easy. It provides us this matching, but realistically, these advantages hold for the other approach as well. Where it's a little bit problematic, and this is why I think the other approach works a little bit better, is it doesn't look at what's in the balance for accounts receivable at the end of the year. It just sort of creates a number and then puts it in, and that can lead to some funny numbers coming out. So the next approach is probably better. And for this one, I'm going to draw up some T accounts because I think it just helps visualize what's going on here. So imagine we have three accounts: a bad debt expense, account receivable, and an allowance. Suppose that a company has a receivables balance of $24,000 at the end of the year. So we have $24,000. It's an asset, so it's a debit balance on the left-hand side. The current balance in the allowance account is $200 credit. So that's how that account looks just before we do the adjustment. What we also work out is we're told that we expect, based on past experience, that the receivable balance at the end of the year should be 2% of the receivable. The allowance should be 2% of the receivables balance. So 2% of this is what we expect not to get back in. That's what we've just worked out, the 480. That's not the expense for the year. That is what we think that account balance will be at the end of the year. So we think this allowance account will have a credit balance of 480 at the end of this year, based on 2% of this. And I think by setting it out this way, you can visually see it a lot easier what you have to do, which is, you don't need a calculator for this. Really? What do we need to do to this to make it go from 200 credit to 480 credit? Yeah, that's it. That's why I like T accounts, because you can visually see it's so easy what you have to do. You just go, oh yeah, that doesn't work out. I just put in what makes it balance. You put 280 over there, that's on the credit. Debit bad debt expense 280, bang, we're done. That's it. Debit bad debts expense 280, credit allowance for bad debts 80, sorted. When it comes to actually fully writing off an account, so if we've got to the point in time where, you know, I've sold you something, I've sold everyone something, and then I realize that you aren't going to pay me back, you've left the country, you've disappeared, and I go, well, I know I'm not going to get my $1,000 back from you. And I'm not saying you're not, like, you look like a person that would pay you money back, so don't take this the wrong way. But if you're the person that, you know, owes me $1,000 and you've scarpered, then I write the bad debt off, and this is how I would do it, is debit allowance for bad debts, credit account receivable. So if we change the numbers just to make it 100 and put it in here, we would debit the allowance and we would credit the account receivable. And what you'll notice from this is an asset account that we're crediting, so we're bringing the asset down, and this is a contra asset which we're debiting, so we're bringing that down. Yeah, it's a bit sunny. We don't touch, in this entry, we don't touch profit and loss. We don't even change the net realizable value of anything, because we're reducing the asset down, but we're also reducing the contra. This doesn't change what the balance sheet looks like at all. It'll still be the same net amount. But it just cleans up the balance sheet. Ooh, okay, so at that point, so that's most of what we wanted to talk about. But if I step back a second, imagine, actually let's go and say the receivables balance at 24. How do I know, how do I prove that there is actually a receivables balance at 24? How do I know that that's happened? Because remember, we get receivables from selling things. What proof is there that that's taken place? Yeah, invoices, receipts. Assuming we're not just making things up, and that's working into the realms of fraud. Let's just assume we're not making receipts up. There will be evidence that you have made sales. That will have happened, and you can prove that's the case. So that $24,000 figure is objective to that sense. You can show that it has happened. What about this $480 figure? How do we prove that? How did we come up with that number? We came up with that number with 2% on 24,000. How do you prove that 2%? It's an estimate. Can estimates be wrong? Absolutely. Now, that in as of itself isn't necessarily a problem. And look, you've got to make estimates. We've got to estimate things all the time. And there's going to be some error in them. And I still think it's better to estimate things than not. So, I mean, look, you still have to do it. We know if we use these two numbers, if we know that people owe us $1,000, I can be pretty certain that we're not going to get $1,000 in. People aren't going to pay us, so we've had to come up with some sort of estimate for 20. That's fine. Where some of the issue lies, what does that number do to your profit? It decreases your profit. That number decreases your total assets. If we just focus on profit, suddenly we have an accounting method which is completely in the power of management to change their profit. How do we know that's 2%? How do we know it's not 1.8% or 2.5%? Simply by changing that number a little bit, you will change your profit. That's it. So on that note, there are some things to think about in terms of what are the incentives that sit behind management. I'm not saying all companies do this. I mean, it does happen from time to time, but it's not just mechanical. There are assumptions and things which are built into this, which I think it's useful to take note of. Okay, so inventory. Oh, I'll clean up the board a little bit. Quick show of hands. How many people buy stuff online? No. What's that? Buy anything. You buy anything online? You've never bought a thing online over the internet. You have. So put up your hand. All right. Real stuff. I'm not just talking about iTunes and whatever. Like, I'm actually physical products that have turned up. Now, for most of, I buy my running shoes online. Haven't had to buy them for a while because they're still going. But to buy them in Sydney is about $250. I can buy them from an English website and have them shipped over for about 100, which is crazy. And they turn up within about a week. So that's pretty good. But I'll buy them and I'll pay $100 for the shoes. And some websites will have free shipping, but they've sort of built that into the prices which they charge the products anyway. And some of it will add shipping on top of the price of the product. And so from Wiggle, you pay $10 or whatever it happens to be. It's about 10. So I'll pay 100 for the shoes and $10 for shipping, and they'll get shipped out. The reason I bring this up is shoes, from an asset point of view, should the shoes, if I was recording them, do you reckon they should be 100 or 110? Yeah, so should they be a $100 asset and a $10 expense, or a $110 asset? So I could debit, because this could be what I could do. I could debit asset 100, debit expense, shipping expense 10, credit cash 110, or I could do it at 110, 110. Those are the choices I've got available to me. So not everyone's obviously answering, but you could maybe think about, okay, which one would we likely do? The way assets get recorded, whether it be inventory or property, plant, and equipment, we'll see the similar sort of way to do it, and we'll explore what that is. So inventory is things which are held for resale in the normal course of operations. Now, certainly companies sell off buildings and they sell off lots of other things, but that's not what they're in business for. So if you imagine Qantas. Qantas from time to time may sell off property. They may sell off actual aircraft as well. But their business isn't doing that. So that wouldn't be inventory. Whereas Boeing or Airbus, that's what they do. They sell airplanes. So for them, you would have inventory. So inventory is held for resale. The intention is important. And that's actually something for those that move on with different levels of accounting. That intent around different things becomes really important, because you could have the same thing at different companies get accounted for in different ways because of the way they get used. So as I used with the airline, you have the same aircraft at Boeing and the same aircraft at Qantas, and they would be recorded as different types of assets because of what their purpose is within the business. This is what I was getting at with the shoes. Following the cost principle, inventory is recorded at its acquisition cost, and that includes all costs incurred to get the inventory delivered or prepared for sale. So everything that needs to be spent to bring that inventory to where it's going to be used and sold, that's what you include in there. So purchase price, tax or duties, cost for shipping, insurance, labor required to assemble. We were talking about IKEA last week. Was it last week or the week before? I was talking to someone about IKEA, and they pay for people to come out and assemble it. I thought the whole point of IKEA was that you just assemble, like it was meant to be easy to assemble, but maybe I'm wrong. Returns and allowances from the vendor. Purchase discounts. So anything included to get it where it is where you need to use it, and then from that point you're going to be expensing things out. Two types of recording systems. We only use the perpetual. So the reason for this slide is just more, if you see anything about the periodic system, don't worry about it. We're using the perpetual system, which means we're updating cost of goods sold each time inventory is sold. So the first bit is, that's not quite right. If we conceptualize the next little bit of what we're trying to do. We're buying in inventory. And what we're trying to, we buy it in and we will create an asset. And what we're trying to work out is what dollar to attach that asset as we bring it in. So that's this next few slides. That's what we're trying to do. After that, when we sell inventory, we're going to create cost of goods sold because we have to figure out the cost of what we sell. And we're going to be trying to work out the dollar figure which we create for the expense. Now, if we were to bring stuff in and then sell absolutely everything, that's really easy. That's just whatever's in there. If we have stuff on hand at the end of the year, so if we buy in $1,000 worth of stuff and we only sell 600, actually let's change that. If we bring in 1,000 units and we sell 600 units, and the units that we bought in had been brought in at different prices, then this becomes a problem. And this is what we're going to have a look at. So that's what we're trying to do. So they purchased $20,000 of inventory on account on the 10th of October. Debit inventory, credit accounts payable. So who wants to be... I'll borrow you for a second. So I bought inventory from you. So at this point in time, I owe you $20,000 and I've got a stack of stuff in my warehouse. Actually, it's not there yet because we've got to transport it in. So I've got debit inventory 20,000, and if we start building the account, inventory 20,000. So that's come in. Devon pays a third-party carrier $300 to transport the inventory to its warehouse. Debit inventory, credit cash. So that gets added to inventory. On the 12th of October, you sold me some dodgy inventory. It wasn't great. There were some problems with some of it. So you're saying, well, you don't owe me, you don't have to pay me $20,000 anymore. You only pay me $19,000. That comes off the cost of the inventory. So we get to reduce the inventory value based on that. And I only owe you $19,000. Devon pays its remaining $19,000 bill to the vendor on the 15th of October and qualifies for a 1% early payment discount. Now the thing is, before, what I should do, should have thought about this, that's all right. Where will we do this account? We'll do it up here. Account payable, when we set this up, was $20,000 and $1,000. You can see that's the $19,000 that I owe. Bless you. You've given me a discount because I paid you early. Now that's good for both of us. I get to pay a little bit less and you get your money much quicker, so you're happy, I'm happy, we're all good. But from an accounting point of view, this causes a bit of a problem. Because if this account payable, now that we've paid it off, I don't owe you anything more. Which means this has got to be down at 0. So I would debit this account payable $19,000. But if I had a cash account, I haven't paid you $19,000 in cash. So I'm just trying to remember what it is. I've debited $19,000 because that's got rid of my account payable to you, but I've only given you $18,810. That's the actual amount of cash that's gone out. These two things don't balance out. So we actually need a third line in there. It's going to be credit to make it all balance, and that credit is going to be to inventory because this reduction, it's still around what I'm paying for the inventory. I've got a slightly cheaper amount of inventory. So that reduces the inventory value by 190. That's all the things that are going on there. We end up with net purchases, or the inventory value in the books, of 19,110. Yes? That 18,810 is because I was given a 1% discount for early payment. So that's where the 190 different. So in terms of actual cash going out, it's less than 19,000. The liability still goes down by 19,000 because that's clear. We've got to make that equal to 0. That's only down 18,810, which means we don't have it matching up. Well, we don't have it balancing. We need another credit in there to the tune of 190, and that is just a reduction to the inventory value.
Why don't you put 1,800 accounts payable and credit side 190?
Like just put it here and here?
Yeah, put 190 and 18.
Yeah, look, I mean, you could. If you wanted to split it up into two, as long as you make sure that the 190 that you put here, like if you did it 18,810 and then 190, as long as you make sure that that happens as well. Like, so you could split that out if you wanted to. But as long as the overall effect is like that. Cool. Now that's got the inventory into here. So get rid of that. That's got inventory. We've got an asset on the books of 19,110. What we need to do is get that inventory out of the balance sheet as we sell it. And they tell us that they sell inventory costing $400 for $600 in cash. Debit cash 600, credit sales 600, debit cost of goods sold 400, credit inventory 400. So in this case, we've got a cost of goods sold of 400. And what you'll see is we're matching up in this period when this occurs, the sales revenue and the cost of goods sold, which is a negative, which is an expense effect. So you get the profit and loss effect for the inventory when you sell it, not when you buy it, because those could happen in two different periods. So you're matching up the revenue from the sale with the expense from that sale. That's the critical thing. But again, if you've got a physical copy with you, circle that 400. Because that was given to us in this case, and that's not always as straightforward. I'm going to put something to you in a moment, which is why you have inventory costing methods. If we were to buy 1,000 units in for this price and we were to sell 1,000 units, really easy. We sold 19,110. That was our cost of goods. But if we bought 1,000 units in and sold 400 units, it starts to become trickier, and I'll point out why. Let's imagine Woolworths. We're doing it because it's the company in the book and it serves a useful purpose. If you don't shop at Woolworths, just use any sort of grocery store and just some sort of fresh produce in there. But I'm going to talk about milk. So you go down to the back section and let's go to the 30th of June, 1st of July. Now, 30th of June, they'll do a stock take, they'll do a count up of all their inventory, and you'll see when you open up the financial statements. You'll see on the 30th of June, you open up and there's inventory, and they'll have whatever the amount of inventory is in there. And we know they've got 980 stores, they'll probably have a fair bit. So let's assume their inventory, the only inventory they have is milk. And the value of inventory on their books that the 30th of June, whatever the year it happens to be, is $10 million. Now just keep that thought in your head for a second. Over the year, they'll be buying milk and they'll be selling milk and they'll be buying milk and they'll be selling milk. And they'll be doing this on a daily basis. My question to you is the following. When you would open up the fridge at Woolworths on the 30th of June, so stock take, maybe it happens to be at like 11 o'clock at night, so just before they shut up, so that is the milk that's going to be in there at the end of the financial year. Would that milk be the milk that they bought on the 2nd of July? Would it be the milk they bought on the 1st of December? Or would it be likely the milk that they bought on the 29th of June? Which is the most likely milk that you expect to see in there? Well, it depends on the branch of Woolworths. You're probably going to be expecting it's likely to be the 29th of June, the 30th of June. You probably would really be hoping that it is the 29th of June. You'd be really worried if you opened up the fridge and you found out the milk was there from 8 months ago. Probably has happened. I'd hope it doesn't happen all that often. So why this becomes important is because they will be buying product, and some of these things last on the shelves a lot longer. If you look at tinned tomatoes, they potentially could be on the shelves for quite some time. If you look at some of their items on there, they could be there not just a day or two. So milk is one which will cycle through pretty quickly. But if you're looking at the inventory which is sitting there on the 30th of June, it's likely to be the stuff which was just bought, not the stuff from ages ago. But the thing is, they don't know with certainty. I'm assuming they don't individually track each carton of milk and say, well, we bought this milk on this date and this is the one that's gone out. They just buy crates of milk, comes in, and it might get mingled up with all the other milk that's sitting there, and then it sort of gets pushed out. Same with tinned tomatoes, same with all their toilet paper, all their various other things. If all of these things were bought in at exactly the same price, this wouldn't be an issue at all. But a lot of things change in price over the year. So Woolworths will have all their service stations. They'll be buying petrol in, and they'll be buying diesel. That fluctuates in price. They'll be buying fresh fruit and veg. That changes in price. So we've got to make an assumption about certain things, and we've just made an assumption about fruit and veg and milk, is that what is left on the shelves at the end of the year is the stuff which is just being purchased, which means if you flip that around, the stuff which gets sold is the stuff from the start of the year, and we sort of sell this way. So we assume the stuff we buy in is the first stuff that we sell, and we buy it and then we sell it straight away, and we buy it and sell it straight away. So what's left is the stuff which is purchased last. That makes sense? What you buy in first with fresh produce is likely the stuff which gets sold first. If you're comfortable with that, that's first in, first out. Now we're going to go through that from a mechanical point of view, how you calculate the numbers, but that is a first in, first out method. The opposite of that is the last in, first out method, which would be assuming for milk that the milk which you see on the shelf is that milk. Does that make sense? Do you reckon that's how they should do it? No, and it isn't. We're not in Australia. We're not allowed to use. That's called the last in, first out method, and we're not allowed to use that in Australia. There are other methods as well, which we will touch on, but we won't do the numbers so much. But it's all about coming up with a method which you think is the best way, that best reflects the items that you've got. The other one, which we look at, is called the weighted average cost, or the moving average, which just looks at all the buys during the year, averages them all, like in a way just averages them, keeps them going on a moving average, and then just assumes it all gets mingled up, and you don't necessarily know which you sell. For fresh produce, that probably isn't that good, but for tinned tomatoes, that probably works okay. For a lot of other, electronic goods, that probably works out okay. So it just depends. Specific identification is not one we'll spend a lot of time on, because it just means you know exactly what you bought, how much you paid for it, and when you sold it. So if you have cars work like this, especially luxury cars, like there's not exactly a huge number of Maseratis floating around the place. So I'm pretty sure the dealer knows this Maserati cost this much and we sold it for this much. We bought this one in, it cost us this, we sold it for that. It's pretty easy to figure that out. So they would know we bought two items, item Y and item X and item Y. We know we sold item X. We can see it. We know how much we paid for X. We know how much we paid for Y. We know we sold X, we know how much we sold it for, which means at the end of the year, the one item that we've got on hand is item Y. That specific identification where you absolutely know that one is what we've got. That's not milk. A carton of milk is a carton of milk. So which method is generally used? Okay. This only gets used for very specific things. Like most companies won't use this method because it's for like unique items, so jewelry or cars or something where you can be like, we know we bought this thing and it cost us this much and we sold it for this much. So that doesn't get used too much. That we can't use. So LIFO we can't use in Australia. So in terms of what gets used in Australia is, I haven't seen sort of research looking at the mix of things that are going on, but FIFO and moving average would be the most common ones, like would be the ones that you'd see. It really then depends on the type of items. Like for things which are perishable, FIFO would make the most sense because that's how the business operates. Bless you. Moving average is one where you see a fair bit. And the thing is, if you want to tell what a company uses, you go to the financial statements, you go to the notes to the first note to the account straight after the financials, look for it where it says accounting methods used, go down to inventory, and it will tell you point blank, this company uses moving average or weighted average, or this company uses FIFO. So they'll actually tell you. You're probably going to see a mix of FIFO and weighted average. So we're going to look at FIFO. When using the perpetual method, cost of goods sold needs to be calculated each time inventory is sold. So we need to do this, and that's what we're about to do. Some firms are able to specifically identify the cost of the inventory sold. And look, as technology and systems get better, I think you're going to see more and more companies being able to do it, but that's got to still improve a lot. So FIFO is first in, first out. So things which are purchased first go to cost of goods sold. LIFO is the reverse of that. We don't use it in Australia. And moving average just averages everything out. So the question that we have is, Wombat General Store sells a specialty goanna oil that it purchases from Dingo Manufacturing. The following is Wombat's inventory activity for September. So we have a beginning inventory, we have 3 purchases, and we have 2 sales at different points in time. So what I'll do here and now is we'll go through the first in, first out method. We'll do it on Excel. As I said, I'll make the Excel file available later. I will also set up next to it the weighted average method so you can cross-check how things work. And I'll make sure I include all the formula and things in there so you can see it. So I'm going to leave, just in case you don't have the numbers with you. All right. So those are the numbers, and I'm going to move to Excel now just to complete this. Okay, so this has already been pre-set up. You don't have to use this exact setup. The idea is just to get a sense of what we're trying to do with this. And we're trying to get a running total of what gets bought in, when it gets bought in, so we know how much stuff we have and the value of it. So in the beginning, nothing in purchases, nothing in sales. We just have 40 units. They're at $12 a unit. Gives us $480. Okay. On the 4th of September, we purchased in 60 units, and we paid $13 a unit, which gives us $780. That means the total amount of stuff we have on hand is 100 units. So we've got 100 units of inventory sitting there. Don't fill out, at this point, this won't make any sense for us for what we're doing. All we need for the total is a total from above, or whatever it happened to be, and what we've just bought in. So we had 480 to begin with. We have 780 that we've just bought in. Gives us a cumulative total of 100 units at $1,260. So if we imagine us drawing this out, we started with 40, we add 60. On the 10th of September, we sold 65. Now, I'm not going to put in 65 at this point because we sell 65 of different units. And because we were doing first in, first out, this was the first units that we had in, and then these were the next units that we had in. So the first units we sell are these ones. These are the ones that we get rid of. So we sell all of these. That's 40 units sold. That's not all the sales, so we need to then move up into the next tranche, which is these guys, and we sell another 25. We sell another 25 of those. So at that point, the first 40 units we sell were the first 40 units that were there at $12 a unit. Gives us 40 times 12, gives us 480. The next 25 units were from this batch at $13 a unit, gives us 325. Whoops. Equals 40 plus 25, that's your 65 units. We don't do the dollar per unit because we don't need to in this case. All we're after is the total, which is 805. That 805, that is your cost of goods sold. That is the cost of goods for those 65 units. And so the running total for units would be the 100 less the 65 you sold, gives you 35. And the carrying value of those units, I'll get to you in a second, is now $455. You have a question?
So it's say you're selling the units, and you're just assuming that that's not the sale price, or you're selling for the...
This isn't, yeah, this is nothing to do with how much we get from them.
Okay.
This is nothing to do with the sales price. This is we're just working out, we could be selling them for $1,000. We're just working out what is the cost of goods sold.
Okay.
Yeah. So is that clear? So that's okay? Sweet. So again, this is cost of goods sold using the FIFO method. This is working out the first units that we bought in are the first units that go out. So these first 40 are what get sold. Then of these 60, we sold 25, which means we can kind of get rid of this stuff, and then we have 35 units left. So then we basically start again. We have 35 units on hand, 35 units at $13 a unit. We buy in, we have 2 more purchases in. The purchase on the 15th was for 30 units at $14 a unit, which would mean we'd have 875 units on hand. So if we go 35 is what we had, we buy in another 30. So now we've got 65 units. We then buy some more, and that is 45 units at $15 a unit gives you 675. Oop, no, 45. Right. So we had 40, we had these, we sold them. We bought in 35, that was from the 60 that we sold part of. We then bought in another 30, we bought in another 45. So what's on hand is 110 units, everyone can see that. And the way we've costed them is the first 35 units are from these guys at $13 a unit, the next 30 are from these guys, the next 45 are from these guys. So we build that up, and when we add them all together, we end up with inventory on hand of 1,550. We have a sale of 50 units, which will get rid of all of these guys and half of those guys. So we get rid of 35 and 15. 35 come from this bracket, and 15 come from that bracket. Which leaves us with 60 on hand and $885 of inventory on the balance sheet, where this number here, the 665 and the 805, those are your cost of goods sold. That's what we've just worked out. As I said, with some of this stuff, it is just a matter of playing with it and just working through it and just getting to grips with it. But the idea at its core is the first things that you buy in are the first units that you sell. All right, so the last little bit. Describe property, plant, and equipment, how they're recorded, expensed, and reported. So what is property, plant, and equipment? We're sitting in property, plant, and equipment right at this moment. You're sitting at property, plant, and equipment. We're looking at property, plant, and equipment. Tangible resources, things we can touch, expected to be used in the normal course of our operations for more than 1 year and not intended for resale. Doesn't mean you can't sell them, you absolutely can, but that's not the intent for holding them. So buildings, like this magnificent one we're standing in right at the moment, is property, plant, and equipment. Property, plant, and equipment for a development company or a building for a development company wouldn't be property, plant, and equipment, because they're developing this stuff to sell. So that's something outside of the scope of what we're doing, but gives you a sense of it. Recording it. Cost of acquisition, same deal as inventory. So we include a whole bunch of stuff, everything that goes in there to get it to where we want it to be and in the manner of use we need it to be ready for. So all these things get added in. We're going to use this, and then I'm going to step away from the slides for a little bit because it gets at where we're going. Purchase price of 60 plus a few other things. Those are assets, like that get built into the asset. Good luck. Registration and insurance gets done as an expense because that's going to be used up over the course of the year. Now, we're going to use that 65 for a second. So keep that in mind. Property, plant, and equipment converts to an expense as you use it. Right at the start of today, we were talking about property, plant, and equipment is debit asset, credit asset. But then that means there's no profit and loss effect. We are ultimately trying to get that cost into the profit and loss statement. How do we do it? Well, that's a very good point. Depreciation. It's an allocation of cost over useful life. It's a matching principle idea because it matches the revenues from the property or from the equipment to the expenses of that. It is nothing to do with market value. I don't disagree that things depreciate in value from just a market value point of view. You drive a new car off the lot, it loses 30%. That's not accounting depreciation. Accounting depreciation is what we're about to look at. Done at the end of the period, and the entry is simply debit, depreciation, expense, credit, accumulated depreciation. That's an expense, that's a contra asset. We saw it last week. If you think about the setup, it's actually not that different to bad debts and bad debt expense and bad debt allowance for doubtful bad debts. You've got an expense item and you've got a contra asset. It's actually very similar. This bit, that's easy. When you have depreciation, that's what you do. The bit which is interesting is what number do you put in? That's the bit which is interesting. So calculating that amount. It does this over a period of time. You need cost, useful life, residual value, depreciation method. So let's map this out for that truck. There are 4 things we need. We need the cost, $65,000. That's 1. We need the life. That's 2. We need the residual value. That's 3. And we need method. That's 4. So let's step through what we're doing with this. We have a truck, $65,000 that we bought it for. We have a useful life. I know for this truck, its useful life, we will get told, is 5 years. The residual value is what you expect that truck to be worth in 5 years' time. The information later on in this question is it's going to be worth $15,000. My question to you. 1, 2, 3, 4. We're going to go from 65 down to 15. Everyone can see that. From 65 down to 15, that's $50,000. That is how much we have to depreciate over 5 years. So what would be a reasonable way of doing that? What would be a really simple way to do that? Yeah, just divide that by 5. Make sense? 10,000 each year. Made sense? You guys make sense? Straight line depreciation, that's all that it is. We haven't really done anything fancy. That's it. You debit 10,000 to depreciation expense, credit accumulation, depreciation 10. This would happen each year, this would happen each year, but the accumulated depreciation, because it's on the balance sheet, would just keep growing. But that's straight line depreciation, that's all it is. But I want you to think further beyond that. How certain are we about this number? Yeah, we bought it. Yeah, that's what you paid for it. If your cash has gone out, you're pretty certain about that number. You paid 65. How certain are you about that number? It's an estimate. We think the truck's going to last 5 years. Could last for 10, could last for 6, could last for 2, I don't know. So we made an estimate about the useful life. How certain are we that it is going to be $15,000 in 5 years? Not really, that's an estimate. We can choose a bunch of different methods for it. Let's ignore the different methods that we could choose and let's just focus on changing these. What happens if we just change that to 10 years? I've literally done nothing different to that truck apart from wipe out one number and put in 10. That changes it from being 10,000 a year. I have halved my depreciation expense by changing a number. That's it. Now, why is that important? What does that affect? That affects profit. By changing this number, we can drastically change what our profit effect is. By changing the residual value, we can change what that effect is. So again, partly is learning the mechanics of it, but partly is thinking about what this actually can do. And when you think companies, one of the biggest assets they have is property, plant, and equipment, which is depreciable, it gives them huge scope to start making tweaks. So it's just something to think about. Yes? They're the same thing. Same thing. Residual and salvage value, same thing. Same thing. Look, residual is technically what it's called, but salvage is getting at the same thing. Okay. Useful life, residual, we've talked about them. Depreciation methods, we've talked about that. Focus on 3 methods. Straight line. We've just done straight line. That's it. There's nothing actually really more that we can talk about it. So I'm not going to talk about it more. I will put together a spreadsheet. We've just done that. I will put together a spreadsheet which deals with all of this and you can see all the formulas so you can track through it. Yes?
With depreciation, everybody goes to the reducing balance where there's more than
Yep.
less than a year. Why do they do that?
All right.
Because I'm there thinking if you've got a business going forward,
Yep.
you want to increase your profits.
You do. Often they'll do, reducing balance works really well for tax.
Yeah, but that's what I'm talking about. So when you've got your reducing balance and you're doing your depreciation tax at a higher amount in the earlier
Yep.
years, therefore it's going to have it's not going to be as beneficial for later years when you've got a higher profit.
Yeah, but I suppose the tax, you're going to get the same total, you're going to get the same, and tax is different from what we're doing here, but you're going to get the same total deduction, so the quicker you can make that deduction happen, the better for you. That's why they have accelerated depreciation. You're going to still get the same amount, it's just when it happens. So reducing balance, as Dame has just pointed out, is about accelerating that depreciation. And so you'll get larger expenses earlier on. The critical thing though is you will still get the same total expense. Now forget about the formula. If you look at the second dot point, it's often 1.5 or 2 times the straight line rate. So if we purchase this truck, same truck, that's critical with this. This is the same truck, same cost, same residual value, same 5-year useful life. The straight line rate is based on 1 on 5. So it's the useful life 1 divided by the useful life, which gives you 20%. If we double that, that gives us 40% per year. So that's what we're depreciating it at. 65 times 40%. Gives us 26,000 in that first year. Carrying amount at the start of the year was 65, 40% of that gives you 26. Accumulated depreciation 26 gives you 65 minus 26 gives you 39. That's 39 is what you use for the next year. And then it's 40% of 39. That gives you 15,000 odd, gives you 41 as accumulated, gives you 23 as the carrying. That's the rate that you put down there. You do it until you get $50,000 total, and that's it, then you've fully depreciated. The last comment I'll make, because I'm aware there is another class about to roll in. Units of activity, the difference is you're not doing it on time, you're doing it on something else. And in this case for trucks, you're doing it on kilometers. So in this case, the useful life isn't done in years, the useful life is done in kilometers. And then you just do it exactly the same idea. just based on how many kilometers a year. So in this case, depreciation per unit is 50 cents per kilometer. You drive 24,000, it's $12,000 a year for that year. Same entry. 12,000, we drive 22, it's 11. We drive 27, it's 13, odd, 17,008. You just adjust it as needed. So there's different ways you could do it, but the critical thing is what happens when we compare them all. Depreciation expense, 50. Depreciation expense, 50. Depreciation expense, 50. Doesn't matter which method you do, you will still, at the end of its useful life, have $50,000 as your total depreciation expense. It just changes when it happens in each year. When it comes to selling an asset, you update accumulated depreciation as necessary. You work out any gain or loss, and that's actually fairly easy to do. Do the journal entries and record it. So imagine we have a car, and sometimes it's easier to do it, to think about it from the journal entry, from the T accounts. So if we have got a car, this is car accumulated depreciation, 25,000 on this side, $15,000 on this side. When we sell it, that account has to be 0, that account has to be 0. So to do that, it would be 25 and 15. So we debit accumulated depreciation 15,000. We credit car 25,000. We get cash of 6, so we debit cash 6,000. That doesn't balance. We've got 21 and we've got 25. We need another 4 here. Debit loss 4,000, which is what? Debit cash of 6, debit accumulated depreciation of 15, debit loss of 4, and credit car of 25. So you're wiping out these accounts, the car and the accumulated depreciation. Cash, you got cash coming in, so you debit that. And then you need to debit or credit whatever you need to do to make it all balance out, which in this case is a $4,000 loss. So you debit loss 4,000 and all done.